The federal government is pushing a sweep overhaul of Nigerian agricultural insurance system, tightening collaboration between National Insurance Commission and the Federal Ministry of Agriculture and Food Security to better shield farmers and stabilize food production. Welcome to Business Point, where we extract the Nigerian economy and the government policies. I am Kike Lomo Okeri. The reform drive follow high-level talks in Abuja between Insurance Commissioner and the Agriculture Minister of State, Ali Abdullahi, with both sides aligning policies to fast-track changes across the insurance ecosystem. At the center of the push is the Nigerian Insurance Industry Reform Act 2025, seen as a turning point to modernize the sector and reposition insurance as a frontline tool for managing agricultural risk. Authorized plans to restructure and strengthen the Nigerian Agricultural Insurance Corporation, giving it a greater capacity to deliver coverage across the entire farming value chain. The reform package goes beyond institutional changes. Government is prioritizing data-driven insurance with the newly created Federal Department of Agricultural Data Analytics expected to power index and parametric insurance models, products designed to trigger payouts based on weather or climate indicators rather than lengthy loss assessment. A joint technical platform between regulators and the ministry will drive implementation, focusing on expanding insurance penetration, improving risk modeling, and building technical expertise across the sector. The broader goal is clear: reduce farmers' exposure to climate shock, unlock financing, and make agriculture more attractive to private sector who have long stayed away due to high risk. This is not a routine policy tweak. Nigerian agricultural insurance coverage remains thin, leaving most smallholders exposed to floods, drought, and market shocks. By linking reform to data, law, and institutional capacity, government is attempting to de-risk the sector and crowd in private capital. The real test will be execution, especially whether new insurance products become affordable and accessible to small-scale farmers who need them most. The Director General, National Pension Commission, Omolola Oloworano, is pushing a major expansion of Nigeria's pension system into the informal sector, flagging it as the country's biggest untapped source of long-term saving and investment capital. Despite 2 decades of reform, pension growth has been heavily skewed towards former workers. The system has crossed 27 trillion naira in assets and over 10 million retirement saving accounts. Yet 10 of millions of Nigerians, traders, artisans, farmers, and small businesses operators remain outside the safety net. PenCom estimates more than 75 million Nigerians operate in the informal economy, contributing significantly to national output but largely excluded from structural retirement saving. This result is a widening protection gap, with most informal workers facing old age without financial security. Beyond the social risk, PenCom is framing the gap as a major economic loss. Bringing even a fraction of informal earning into the pension system could unlock trillions of naira in long-term domestic capital fund that can be channeled into infrastructure, housing, power, and enterprise financing. To close the gap, the Commission is rolling out accredited pension agents, field-based and tech-enabled intermediary designed to take pension activities directly to markets, firms, and communities. The model ties agents earning to consistently contribution and long-term participation, aiming to drive trust and sustain enrollment. The first license has been issued with Awaba, with fintech firm, telecom operators, cooperatives, and payment platforms expected to scale the initiative nationwide. The move aligns with the economic agenda of President Bola Ahmed Tinubu, particularly around the financial inclusion and domestic capital mobilization. Foreign investment into Nigerian manufacturing and production sector has plunged sharply, exposing a widening disconnect between headlines capital inflow and real economic activities. Data from the National Bureau of Statistics shows that investment into manufacturing dropped by 54.11% in the first 9 months of 2025, falling to $463.52 million from $1.01 billion recorded in the same period of 2024. The decline is stark across the year. Manufacturing attracted $129.92 million in the first quarter of 2025, dipped to $72.25 million in the second quarter, and recovered slightly to $261.35 million in the third quarter. This is well below 2024 level, when inflow peaked at $624.71 million in the second quarter alone. The drop comes despite a surge in overall capital importation. Total inflow more than double, rising to 131.96% to $16.78 billion in 2025, from $7.23 billion in 2024. In the third quarter of 2025 alone, inflow jumped to $6.01 billion, up from 380% year on year. But the quality of the inflow tells a different story. Portfolio investment, short-term, high-yield, financial inflow dominated, accounting for about 80% of the total inflow in the third quarter. Foreign direct investment, which typically fund factories and long-term projects, contributed less than 5%. Manufacturing itself attracted just 4.35% of total capital. Most of the money flowed into banking and financial sector, leaving the productivity based on funded. Industry stakeholders says this reflects investors' preference for quick return over long-term commitment, while monetary reform and attractive yield have boosted confidence in Nigerian financial markets. The real sector remains weighed down by deep structural challenges. Manufacturers continue to battle unreliable power, high energy costs driven by self-generation, weak transportation network, volatile input price, and difficulty accessing foreign exchange for the raw material. Policy uncertainty and regulatory bottlenecks rather raise the risk profile from long-term investment. The situation has already taken a toll. The Manufacturers Association of Nigeria reports a steady decline in the sector contribution to the GDP from 29.9% in 1981 to just 8.2% in 2024. Growth has slowed to near stagnation, while hundreds of firms have shut down and thousands of jobs have been lost. Infrastructure gaps estimated to at over 13 trillion dollars continue to choke productivity, with poor roads and logistics system driving post-harvest losses and discouraging industrial expansion. In response, the government has launched the Nigerian Industrial Policy 2025, targeting a rise in manufacturing share of GDP to 15% by 2030 and 25% by 2035 through incentives and cost reduction measures. Analysis shows that Nigeria is attracting capital, but the kind that builds factories or creates large-scale jobs. The surge in the portfolio inflow signals confidence in financial markets, not in production. Until power, infrastructure, and policy stability improve, investors will keep chasing quick return, leaving the industrial base weak and job creation constrained. Green investment projects across Africa are chasing $3.09 billion in funding as continent-wide pipeline of climate ventures head to Africa Green Economy Summit 2026 in Cape Town. The pipeline spans more than 25 countries and cuts across renewable energy, waste management, circular economy solution, sustainable agriculture, blue economy initiative, and nature-based projects. It includes early-stage startup, scaling SMEs, and large infrastructure deals, signaling a maturing green investment landscape on the continent. Organizer says the summit is structured to move beyond talk into deal making. Investors and project owners will engage through target pitch session, closed-door briefing, and one-on-one matchmaking aimed at securing real financing commitments. The funding mix is expected to rely heavily on blended finance, combining public and private capital alongside concessional funding, catalytic capital, and risk-sharing tools designed to de-risk projects and attract large-scale investment. The focus is shifting towards scaling proven solutions from decentralized hydrogen production to circular industrial system and chain. The pipeline reflects a push to turn pilot projects into commercially viable industries. Backers include development finance institutions, commercial banks, climate funds, venture capital firms, and asset managers, all aligned to different project stages, from early funding to full-scale equity and debt financing. Analysis shows that Africa's green pipeline is expanding, but funding remains the bottleneck. The $3.09 billion target highlights both opportunities and the urgency. Investors are interested, but risk perception, project bankability, and execution capacity still slow deployment. If blended finance structure work as intended, this could shift climate projects from pilot phase to real economic drivers, creating jobs, boosting manufacturing, as well as strengthening resilience. Foreign investment into Nigeria is on track to hit $23.3 billion in 2025, marking the strongest inflow in 6 years and signaling renewed investors' appetite for the economy. Analysts at the Avinvest have upgraded their forecast from $19.3 billion, pointing to sustained momentum driven by a more stable naira, easing inflation, and high domestic yield that continue to attract offshore funds. Data from the National Bureau of Statistics shows that capital inflows surged to $6.0 billion in the third quarter alone, the highest quarterly level since 2019. Total inflow for the first 9 months have already reached $16.8 billion, underscoring a strong rebound. The rally is being overwhelming by portfolio investment. In the third quarter, this short-term flow hits $4.9 billion, accounting for more than 80% of the total inflow. Over 9 months, portfolio investment climbed to $14.3 billion, driven largely by demand for Nigerian bonds, equity, and money market instruments. This surge reflects improving macroeconomic signals. The naira has stabilized, inflation has moderated, and yields on instruments such as open market operation remains above 19%, making Nigerian highly attractive for carry trade investors seeking quick return. But beneath the strong headlines numbers lies a structural weakness. Foreign direct investment, the type that builds factories, creates jobs, and supports long-term growth, remain low. FDI contributed just $296 million in the third quarter, about $565 million over 9 months, accounting for a small fraction of total inflow. Sectoral data reveals the imbalance. Most capital is flowing into banking and financial markets, while critical sectors like manufacturing, infrastructure, and agriculture continue to receive limited investment. Analysts warn that this pattern reflects confidence in Nigeria's financial market, not necessarily in its real economy. Portfolio flows are highly volatile and can reverse quickly in response to global interest rate or risk sentiment. While the current surge provides liquidity and support exchange rate stability, it does little to expand production capacity or drive broad-based job creation. This means Nigeria attracting capital again, but it is largely hot money, chasing yields, not long-term investment, building the economy. The rebound offers short-term stability, but without stronger inflow into manufacturing, infrastructure, and agriculture, the gains risk being temporary. The real challenge is converting this momentum into durable investment that drives jobs, exports, and industrial growth. All right, let's take a quick short break now. We'll be right back. Don't go away. Stay with us. Welcome back. If you're just joining us, it's Business Points, where we explore the Nigerian economy and the government policies. Nigeria is making a fresh push to reclaim its place in the global palm oil market, moving to cut a $600 million annual import bill and ramp up local production. A high-level delegation from the Council of Palm Oil Producing Countries led by Malaysia and Indonesia has opened talks with Nigerian officials to fast-track the country's transition from observer status to full membership, positioning it for deeper global integration in the palm oil value chain. The urgency is clear. Nigeria consumes between 2.5 and 3 million metric tons of palm oil annually, but produces only about 1.4 million tons. The shortfall is filled through imports, draining foreign exchange and exposing the country to global price swing. Government is now framing palm oil as the strategic economic lever, not just for food supply, but for jobs, rural income, and export earning. The Federal Ministry of Agriculture and Food Security is driving reform aimed at boosting yields, supporting smallholders, and attracting private investment into processing and large-scale plantation. Nigerian path to Council of Palm Oil Producing Countries membership is already underway. The technical engagement, stakeholders consultation, and validation process lined up through 2026. The goal is to reposition the country as a dominant Africa producer with stronger global market influence. Industry players says the fundamentals are strong. Nigeria remains Africa's largest producers and consumers of palm oil, but years of underinvestment, poor seedling, and weak infrastructure have held back output. Closing the production gap could unlock major gain, cut import costs, create jobs across rural communities, and expand agro-processing industries. Nigerian palm oil revival is long overdue. The country has the land, demand, and the history, but the productivity. Joining Council of Palm Oil Producing Countries could boost standards and global positioning, but real success depends on fixing local bottlenecks, seedling, financing, and infrastructure. Without that, imports will keep rising and comeback will remain more ambition than reality. Let's take a quick look at the stock market before we call it a wrap on Business Point today. Nigerian stock market delivered its strongest week rally yet, the investors pocketing a massive 8.1 trillion naira gain in as equity surged to new high. Data from the Nigerian Exchange Limited shows market capitalization jumped sharply to 126.16 trillion naira, up from 117.03 trillion naira the previous week, the highest level recorded this year. The benchmark all-share index also soared by 6.95%, closing at 194,989 points and pushing deeper into record territory as buying pressure intensified across major sectors. The rally is being driven by aggressive institutional positioning in fundamental strong stocks, alongside renewed investors' confidence in the market's near-term outlook. Global oil price added fuel to the surge. Brent crude oil held about $71 per barrel, while West Texas Intermediate hovered around $66, supported by the geopolitical tension in the Middle East. For Nigeria, stronger oil price translates into improved fiscal outlook and better investors' sentiment toward local assets. Market activity spiked alongside prices. Trading volume jumped to 148% week on week, while transaction value rose to 87%, clear sign of increased participation and liquidity. Gains were broad-based. Industrial goods led the charge with 10.1% rise, followed by oil and gas, consumer goods, banking, and insurance, all posting solid gains as capital rotated into key sectors. Looking ahead, the market is expected to remain active with earning releases, dividend declaration, and Central Bank of Nigeria policy direction likely to shape investors' decision. This is a liquidity-driven rally backed by strong oil price and institutional money, not necessarily a reflection of deep economic expansion. The upside remains intact in the short term, but the pace of gain raises the risk of profit taking. Sustainability will depend on earning strength, policy signals, and whether foreign investors deepen their participation. Bitcoin tumbled sharply in early trading, dropping towards $64,000 as fresh uncertainty around U.S. trade policy rattled global markets and triggered a wave of risk-off selling across crypto. The world's largest cryptocurrency sank nearly 5% to around $64,300, its lowest level in week, while Ethereum fell even harder, shedding over 5% as the pressure spread across digital assets. The sell-off wiped roughly $100 billion off the total crypto market in just 24 hours, underscoring how fragile sentiment has become. At the center of the volatility is the confusion around U.S. tariffs. A Supreme Court of the United States ruling has disrupted the legal basis of certain trade measures, while Donald Trump signaled a fresh tariff hike to 15%, spoken investors already on edge. The result is a classic flight from risk. Crypto, equities, and other speculative assets are all under pressures, while traders scramble to hedge against further downside. Market positioning shows strong defensive bets building around $60,000 level, now seen as a critical support zone. Bitcoin weakness also reflects a deeper issue: lack of strong narrative. Earlier, optimism tied to the pro-crypto policy expectation has faded, leaving the market without a clear catalyst for recovery. The broader trend is turning negative since its post-election rally peak above $126,000. Bitcoin has lost momentum, dragging the wide crypto market down by more than $2 trillion. Institutional appetite is also cooling, with US Bitcoin ETF recording sustained outflows. Analysis shows that this is a micro-driven, not crypto-specific. Bitcoin is behaving like a high-risk asset, reacting sharply to global policy uncertainty until there is a clarity on trade policy or new bullish catalyst. Markets are likely to stay volatile. A break below $60,000, which could trigger deeper selling, while any recovery would deepen on renewed investors' confidence and clearer economic direction. All right, this is what we call it a wrap on Business Point today. Join me again next time on Global Television, channel 365 on DSTV and 276 on Star Times. To stay connected, kindly follow us on all our social media platforms using at Global TV NG. Till I come your way again, I am Kike Lomo Okeri. I celebrate you all.